It's very interesting to note that Sam Bankman-Fried, who has either committed gross negligence or outright fraud, he didn't like Bitcoin. He didn't like it. And why didn't he like it? It's decentralized, it's fully transparent, and he couldn't control it.
Hey guys, welcome back to Library of Wealth. Today we have Cathie Wood giving us an update on the collapse of FTX and the damages caused to the crypto market. Cathie outlines what effect FTX's bankruptcy is having on the confidence and credibility in the industry. Cathie believes that despite FTX's internal problems, Bitcoin will actually be stronger because of it. Let's check out this latest interview with Cathie Wood as she talks about what went wrong with FTX and what effect this will have on Bitcoin and the crypto market. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
He was trying to control the crypto world, master of the universe. And that was a recipe for failure. It's been most unfortunate because so many people have been hurt because of it. But I do think the big lesson, and even the newest SEC commissioner is saying, you know what, we really have to double down on this idea of decentralization and transparency and help to propagate this new world with the right kind of regulation. And it's not like they have to change regulations. As Brian Armstrong says at Coinbase, we don't need new regulations. We need clear regulations. And we certainly need more clarity from Gary Gensler at the SEC. And the other thing we need, I would submit, is we would have saved a lot of people from some of the catastrophe that FTX has presented them with something like a Bitcoin ETF, a regulated. Instead, a lot of people went offshore and then got carried away with it. So I think the SEC deserves some blame for what has gone on as well.
If the sentiment surrounding these new assets is bad and people don't want to buy them, to some extent, does it even matter if the technology is good or not if people don't want to buy Bitcoin, for example?
I think what we're learning because of FTX is how much more important fully transparent, decentralized networks will be to financial services going forward. FTX, Celsius, 3AC were all closed networks, opaque systems. You couldn't see what was going on. And what happened as they were going down, the people who were on the fully transparent distributed networks were able to get out scot-free. They saw what was going on. There were margin calls for those who were over-leveraged, but the system worked. It didn't skip a beat. Those other companies went out of business. It's a little bit like 0809. The old financial world is very opaque, not transparent. The new world that we're entering, because it's so obvious now, decentralized and transparent is the way to go. Those networks didn't skip a beat. All of the transactions were completed. And there are all kinds of metrics saying they're getting stronger now.
With the final deal ultimately rejected and FTX filed for Chapter 11 bankruptcy, this shocked the whole financial sector and the cryptocurrency market. According to Cathie, despite the magnitude of the FTX disaster, this should even fuel greater adoption of Bitcoin. With an existing price suppression in the wake of the FTX collapse, many cryptocurrency analysts, however, think that Bitcoin's ability to maintain its present price levels in the face of a significant black swan event is evidence of the resilience of Bitcoin.
And then two new crypto strategies. I believe the best time to launch new products is when times are tough and they're out of favor, because that gives the end investor an opportunity to ride the next wave. And, I really believe, if I can just back up and give you a sense, during COVID, as we learned the disaster that COVID would be, the market dropped in 1 month, roughly 30%, depending on the measure. We were down 46%. We have never seen a market like this. This is worse than 0809. And I think many technicians basically took a chart of the tech and telecom bubble and the bust, and they said, okay, that's what's going to happen. That has happened to us and more. This is worse than the tech and telecom bust. The difference between the two periods is we've got into an irrational market in the late 90s. Investors were piling on technology stocks, actually trying to outcompete indexes and each other. So they ended up with 40% technology, but the technologies were not ready. We didn't get cloud until 2006. We didn't get breakthroughs in deep learning until 2012. Not only were the technologies not ready, the costs were way too high. The technologies are ready, the costs are low enough. The seeds for what we're investing now were planted during the 20 years that ended in the tech and telecom bubble. That was irrational. And I think we're on the flip side of the bubble right now. I think what's going on right now is irrational. Many of our stocks are below where they were at the low point in 2020. This inflation problem built up over 15 months. And instead of increasing interest rates twofold, 10 to 20%, which is what Volcker did, Chairman Powell has taken interest rates up 16-fold. Again, never seen that before. And I do believe that the surprises now are going to be on the low side of inflation expectations, dramatically so. We believe that inflation will drop below the Fed's 2% inflation rate sometime next year. And the pipeline is telling us that. Commodity prices, inventories, which are overwhelming and causing all kinds of discounts. And the bond market itself, whenever there's a yield curve inverted, it is saying, okay, growth is going to disappoint, or inflation is going to be lower than expected, or both. The market is trying to figure out how high is high. And you've got some observers, economists out there thinking it could be 6 or 7%. And so the market is holding back and saying, wait, we need some evidence. Now, I think the evidence is becoming very strong because long bond yields are down at 3.5%. The long bond market does not think interest rates are going to 5 or 6%. It's been moving in the opposite direction. We got up to 4.25% on the 10-year Treasury, and now we're down to 3.5%. So the bond market, I think, is speaking pretty loudly. And the bond market itself, which would be the most sensitive to rates going up, is moving in the other direction.
Even though it's been an extended and brutal bear market, Wood says that Bitcoin is in a race against traditional finance and asset classes. She remains one of the biggest cheerleaders for Bitcoin within the institutional space. Cathie has given us a bullish price prediction for Bitcoin's valuation by doubling down on her forecast of $1 million per coin. She is confident of Bitcoin's ability to be at the heart of a revolution in money, given its multiple use cases. What do you think about Cathie Wood's update on the collapse of FTX, the damage it's caused to the crypto market, and where Bitcoin is headed? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.